Today I want to speak about market declines, specifically at the point of approaching or being in retirement. We've recently gone through a few market wobbles, as we tend to do in most years, and don't worry, I'm not going to cover the specifics of Mr. T and the T word because I'm sure you've heard enough, but also we have next to no control over that, so it's better to focus on the things that we can control. So if you're coming up to that point of retirement, or maybe you're already there, this video should help with the 5 things you can do to help manage market declines. Now, right out of the gate, the first point we'll start with is acceptance. We can't go into a multi-decade retirement with our fingers crossed, hoping that we don't experience a decline in markets. This is going to happen. If you look at investment performance from a basket of shares, ownership of the world's companies, every single calendar year, you are likely to experience a temporary setback from a previous high, a decline in the markets. This chart from JP Morgan helps to illustrate the point that in most years, the markets finish positively from January to December, and in this example here from 1986 through to 2024, there were 27 up years to the 12 down years. But in every single calendar year, there was a temporary setback from a high, drawdown in the markets, that ranged from about 4% to 43% and averaged around that 12 to 15% mark. This one here from Vanguard helps remind us that even with those temporary pullbacks every year, it's quite uncommon that we see a major market decline, a bear market, if we define it as a 20% pullback from the previous high. Now, from the information here, we could say that typically every 6 to 7 years, you might experience a bear market, but of course the timing, the depth and the longevity of the bear market can't be known in advance. What we can say from looking at this is that in a typical 3-decade retirement, you're likely, you can almost expect, to go through 4 to 5 market declines during your retirement, with 25 to maybe 50% pullbacks of your investment value during that time frame. So we start with acceptance. We go into retirement eyes wide open. We're not hiding behind the curtains hoping the world doesn't serve us up a market decline, because it will. We know it will many times during our retirement, and acceptance of this helps us to keep a calmer head and make decisions from a more rational standpoint. So if we know that investment market declines are going to come along at a few points during our retirement, is it as simple as just not selling in a panic and continuing to draw, say, 4 or 5% for our investments blindly throughout retirement? Well, you could do that, and in most cases you'd be absolutely fine. But we do have to accept there are some scenarios where blindly continuing your withdrawals without some awareness of what's going on in the world could have led to problems. And this is best expressed through the term known as sequence risk. When it comes to withdrawing money from your investments, market declines do have an impact on the sustainability of that fund. When markets go down, you need to sell more shares or more units in your fund in order to raise the same pound coin amount that you would have done when it was at a higher price. It leaves less invested for the eventual recovery. It's all very well us accumulators that are building our wealth welcoming a market decline as a discount on shares. It's not so welcome when you're withdrawing from your money. Now, a short-term temporary setback isn't that much of a big deal. If we think about the 2020 pandemic, it was over in a month or two, really. And if you are withdrawing a reasonable monthly income from your portfolios, a month or two here or there isn't going to do too much damage. But a prolonged period of negative or even lower than average returns can have a huge impact as it sort of cascades down later on to retirement. And this is particularly true in the early stages of retirement, when your fund's normally the largest and you're drawing down on it the most because you're probably most active in your earlier years of retirement. To help illustrate my point, let's have a look at a quick example with 2 hypothetical investors, and they're going to retire at 2 different points in time in recent history, but they're going to retire with the same £500,000 invested pot of money, and they're going to draw £25,000 a year, doing this on a monthly basis, so a 5% withdrawal rate, and they're just going to keep that steady, so no increases throughout the retirement period. I'll use the MSCI World, a basket of companies essentially, to illustrate this, as it's just for guidance purposes here. The first of our investors retires in January 2009, and over the next 15 years, taking them to that kind of mid-retirement point, their fund actually trebles. They end up with 1.6 million in the pot, even after taking their withdrawals. Now, yes, they've had a few temporary setbacks along the way, but they're laughing. They're thinking, well, this investment game is pretty easy. I've never been underwater on my investments, and all I've done really is seen it grow over time. They're naturally feeling pretty good about the decisions that they've made. But let's take that same strategy, same withdrawal, same pot value, but now say that our retiree starts their journey in January 2001. Well, over their 15-year period, for comparison, they have a pretty tough time. I mean, they are underwater on their initial investment amount from the get-go. They kind of live in that £300,000 range for quite some time. And then the 2008 market crash drags them down into the sort of £200,000 range, finishing out their 15 years with about £230,000 in the pot. Naturally, they're not feeling so good about the decisions they made. They did nothing differently, but unfortunately something outside of their control, the sequence of the returns they got, meant they had a very different experience to the first investor. And yes, okay, I have picked two pretty extreme points from a timing perspective here, pitting the 2009 market recovery versus the start of that sort of 2001 dot-com crash, but it does help illustrate the point that I wouldn't necessarily just continue with my withdrawals blindly throughout retirement, ignoring what's going on in the world around me. Now, you can't completely remove sequence risk, but these next 3 points can help in addressing it. If we think about typical market declines and using that data from Vanguard, we could say that a market decline, a bear market, might last anywhere from maybe a month or two to maybe 2 to 3 years at the worst. Well, if we accept that's the case, we might argue for having a cash reserve. So setting aside some cash savings in an easily accessible account that we can go to and draw upon when the market goes through some of its worst declines. Most of the time, it wouldn't be to your advantage to have a cash reserve because the market is moving up positively most of the time. If we take our January 2009 retiree as an example, it wouldn't have helped him to have had some of that money sat in cash. In fact, it would have been a huge drag on his long-term returns. But saying that, if we talk about our 2001 retiree, it would have certainly helped them to have had some of that money set aside in cash, allowing them to avoid drawing from their investments during that early sort of 2001 to 2003 period. I like to think of the cash reserve as an insurance policy, protecting against the worst that sequence of returns risk can do to an investor. Think of it as buying yourself time during a market decline. Our investors in our examples here wanted £25,000 a year, so they might set aside £25,000 or maybe £50,000 that buys them a year or two of time. There's no right answer here. If you want more time, more insurance against that risk, set aside £75,000 in this example. Most bear markets aren't lasting more than 3 years. If you are going to use the cash reserve strategy to help see you through difficult points in market declines, I would say go in with a rule around how you're going to do that. You don't really want to be flicking between drawing from your investments 1 month, then cash, then investments and cash, and tying yourself up in knots, because you are going to have plenty of market volatility from year to year, as I've said. So you need a rule that says something like, well, if my invested money comes off by maybe 20-25%, that's when I'll go to my cash reserve and draw from there. And if it recovers to say maybe 10 or 5% from the previous high, I'll switch back to my investments, but I'll use those parameters as the deciders for when I go between the two, as opposed to worrying from month to month whether I should be drawing from cash or not. The idea being that if you do have a major market decline, 20-25% or more, it'll help see you through the worst of that decline and prevent you from drawing on your investments at some of the worst points. And then when the market does recover, you can then draw some more from your investments if you choose to do so to replenish that cash reserve, ready to go for another market decline. As a financial advisor, one of the things I've noticed about a cash reserve is it does help put people's mind at ease about their investments. So if you have an invested pot that's fluctuating all the time, you're thinking, oh, I'm so worried about investment markets, it's a big psychological pressure. But if you suddenly sort of reframe it and say, well, even if the market declines, I've got 2 to 3 years worth of cash on hand that I could go to. There's something about that that just settles people and allows them to stay invested with the bulk of their money. So I certainly think it's a tool that can be used for your own mind to help you invest if you're not all that comfortable with investing in general. For point 4, I'm going to try and keep this relatively short and simple, and it's just to say diversify your investments. Everything that I'm talking about here in terms of experiences for investing and market declines is based on long-term data for holding a basket of companies. We can look to indexes and analyse what's gone on to get some feel for what might happen in future. I'm a big advocate for using index funds because it keeps your costs low and avoids you having to make decisions about the individual companies you go into. If you do choose to speculate on individual companies, weird and wonderful assets, or even just an active manager with a really consolidated portfolio of stocks, then by all means be my guest, you can go ahead and do that, but just appreciate that your range of outcomes has dramatically increased. It could make you insanely wealthy, but if you get these calls wrong, things could unravel very quickly and you might find yourself running out of money far sooner than you anticipated. Of course, I am a strong advocate for the use of shares, equities, ownership of companies within a portfolio, but I do appreciate that it's volatile and it's not for everyone. And if you're not going to stick with an equity portfolio because you just can't stomach the ups and downs that come along with it, I am by no means against having a blend of other assets. Typically, that's going to be fixed interest, high quality, short-dated bonds to help balance this out. And it doesn't need to be complicated. There are multi-asset funds out there that blend bonds and equities together, and others that introduce things like commercial property or alternatives, gold, etc., that can help sort of dampen the volatility of shares. Personally, I think shares are the best defense against the inflation risk. You want a real return over a 30-year retirement period, but if you're not going to stick with that portfolio, as I've said many a time, the best portfolio is the one you're going to stick with. So again, certainly not against diversifying into other asset classes. Lastly, I wanted to touch on having a base of guaranteed income. It's a lot like the cash reserve in that psychologically this can be of huge benefit. Most people have a core expenditure need, the utility bills, the council tax, filling the fridge. These things have to be paid. And if you run through those numbers, have a look at your direct debits, etc., you'll probably work out that there's a rough monthly amount that you need to have coming in to cover that core expenditure. And if you know that that's covered by, say, the state pension or a defined benefit scheme pension like the NHS or local government, or perhaps even an annuity, it takes a lot of the pressure off any invested money you've got. Let's say we look at the annuity route. So you've got a pot of money and you're weighing up whether you should have any guaranteed income. Well, you might buy either a lifetime annuity or even a fixed term annuity that runs for a set period. Perhaps say you retire at 60 and you want to bridge that gap to age 67 maybe when your state pension's coming in, and you know that you want to have a set amount each month. As a quick example, let's say that amount that you need is £1,000 a month, and you need this from age 60 through to age 67, a 7-year term. Well, in today's annuity market, that fixed term annuity might cost just over £70,000. Now, I'm not saying that's for everyone, and some people might prefer to just simply progress with drawdown and take what they need. But it's something to weigh up for the psychological benefit of knowing that your core expenditure is covered, and it can allow you again to be a little bit more at ease with your investments when you go through these market declines. I hope that the points raised in this video have been some help. If you're nearing or if you're already in retirement, you're inevitably going to go through a few market declines if you've got invested funds, and there are just a few things that you can do to help. The main thing I would say is have some plan, have some direction, and then adjust that as time goes on. If you want help in that aspect, if you want help either on planning or the product side, I'm an independent chartered financial planner with over a decade of experience, so feel free to message me on the details in the description for the video here. Ultimately, one of the main things I think you can do is just tune out the noise, particularly from the media whose interests are not aligned with yours. They're going to sensationalise every market decline to help get clicks and views. Try and tune that out, talk with friends, talk with an advisor, but make decisions from a rational standpoint. If you've liked the video, if you wouldn't mind pressing that like button, subscribe here if you're new, and I hope to see you for a future video.